America was hit hard by a financial crisis in 2007, which was the largest financial crisis since the Great Depression. There was a large impact of the economy on business during the economic crisis of 2007 through 2010. Business was impacted by the decline of spending by consumers and by no available credit. Some indicators that show that businesses are in trouble are the monthly retail sales, the number of bankrupt businesses, and the unemployment rate. The monthly retail sales report shows that consumers bought fewer products during the financial crisis. A drop of about 10% in spending was seen in the late 2008. When retail spending drops, businesses will tend to save money by cutting costs. The key way to cut costs is through layoffs. The latest sales figure is 7.9 below the green line endpoint. The blue line excludes the impact of the financial crisis, and the latest sale figure is 17.7% below the blue line endpoint. Businesses must invest to grow. In order to invest, businesses need capital. Capital comes from bank loans, issues of stock, and private equity funds. A major source of investment funds are the banks. However, investment firms were collapsing because the banks made bad mortgage loans. When consumers stopped consuming, some businesses, such as the auto industry, had major decline in sales. Companies like General Motors, Chrysler, and Ford. These three companies focused on selling bigger vehicles like SUVs and trucks. But then oil prices started to rise, so the demand for larger vehicles went down. The U.S. automakers entered the crisis very weak with the wrong product in inventory, a drop in consumer spending, and a lack of bank funding to invest in new products. Both GM and Chrysler filed for bankruptcy. So, America had to bail out both General Motors and Chrysler, which those bailouts were paid by the taxpayers. Many businesses filed for bankruptcy during the financial crisis. Over 100 mortgage companies went out of business. Business bankruptcies rose from 2006 to 2009 and peaked in quarter 2 of 2009. The rise in bankruptcies was caused by the credit crisis. The U.S. government has declared that the recession started in 2007 and ended in early 2009. Businesses are showing signs, but still have a long road to recovery. The financial crisis did do some good for businesses by sorting out healthy companies from the weaker ones. It caused businesses to conserve and cut spendings, including jobs, and to give healthy companies a chance at becoming stronger.